The following was recorded in front of a live studio audience at the Studio 21 Podcast Cafe. This is the United Podcast Network.
Welcome to Easy Money New England.
Oh, can somebody help us here?
We can, because we are real estate and mortgage professionals.
Where you go? Just come in and browse.
That's right. Come on in, listen up, and learn.
How long do you intend to browse?
In a short period of time, our panel will teach you some tricks that might make your house buying easier.
You don't ask her how long she intends to browse.
You might not be looking for a mortgage today, but we'll get you ready.
You don't look like browsers.
Are you looking?
No, what do browsers look like?
Yeah, maybe I'm half browse.
On his father's side.
This is Easy Money New England
Let's show the lady we're browse.
with your host, Brian
Hey,
DAmico.
look at us, we're browse. One more word out of you and he gets it, all right? Come on.
Welcome to another edition of Easy Money New England, where every week we bring you money-saving tips or money-making opportunities. And today's show, this is a little bit of both, actually a lot of both, and I'm actually really excited to talk about 1031 exchanges. If you don't know what a 1031 exchange is, you will know at the end of this hour, or you could talk 7 hours, right, Lynne?
Yeah, I have.
So today with us we have Lynne Bagby, and she's from Asset Preservation Inc. And I've known Lynne for a very long time, and she's great at what she does. So Lynne, welcome to the show.
Thank you. Good morning, Brian. Thanks for having me here.
So Lynne, let's just, a lot of people, they drive around or they listen to this at work. What is a 1031 exchange? Everyone always asks, what is a 1031 exchange?
Well, it's actually an election of the United States Tax Code. It's IRC Section 1031, and it's a tax deferment treatment for the sale of like-kind investment property. So in your world, really, it would be real estate.
Real estate.
That you've held for productive use in trade or business or for investment purposes.
Yeah, right. So real estate, this is a real estate show. Obviously, people use 1031 exchanges for real estate primarily, but I've heard people use 1031 exchanges for aircraft or something like that.
Yes, and there's 13 different asset classes.
13
So
different assets.
yes, so it's any kind of investment property that you've held for productive use in trade or business, which would be renting it out and collecting an income from it, or running your own business out of it, or using business equipment in your business, or holding for investment, which would be the case of holding for appreciation, as in the case of raw land.
Pretty interesting. Okay, so what doesn't qualify for 1031 exchange?
Your primary residence,
Okay, so primary residence,
stocks, bonds, and notes,
stocks, bonds, and notes.
inventory, property held primarily for sale. This will not work for developers or builders. If they're building something and then they sell it, it's property held for sale.
What if your primary home is a two-family and you sell your home? Is that eligible?
Well, if you live in one of the units and you rent out the other one, the value of the other unit could be, it's called a split treatment transaction.
Split treatment, okay.
You take Section 121, which is your primary residence on the part you live in,
Yep.
which is the exclusion. And then the other part could qualify for Section 1031 for investment property
Okay,
purposes.
so I've done this with a friend of mine, and he saved a boatload of money on taxes. Was able to, so in general speaking terms, with all the equity that's in the New England market right now, if you were to sell your home, you would pay the tax man a pretty penny. But if you
No, you wouldn't. You get the exclusion.
only if you use a 1031 exchange.
No.
Right?
On primary residence, if you
Yes.
sell your home, that's Section 121. It is an exclusion. $250,000 capital gain if you're single, $500,000 if you're married. You get an exclusion on that. And then,
But if it's investment property, say it's investment property, and
Okay.
you're about to, you have all the increased equity, and let's say it's a three-family, and you paid $100,000, and now today it's worth $500,000.
right.
They're gonna get pretty much walloped in taxes.
Yes. Let's assume it's a full investment. Let's
Yep.
assume they don't live there. It's a three-family. You've held it for several years. Could be 2, 3, 4, 5. And now you want to sell it. You'd have a capital gains tax. Doesn't go against your ordinary income. There's a depreciation recapture tax, which is a flat 25%.
Yep.
Then you've got the federal capital gains tax, which there's a formula for that.
Yep.
And then there's the net investment income tax, which is part of the Affordable Care Act, formerly known as the Medicare surcharge tax. That's 3.8%. And then you've got the New Hampshire does not have a state capital gains tax, but a business tax could apply, which is separate from Section 1031. So that's
right. So just taking that example, if we had a $100,000 home, and not a home, but an investment property, and it goes to $500,000, you have a gain of $400. you're going to get taxed a pretty hefty penny. If you use a
Yes.
1031 exchange, how does that kind of fit into the puzzle?
Well, it's to keep you invested in real estate. For example, we're going to use real estate as our asset that we're talking about today, not
Yeah.
business equipment and
Right.
things. So basically, what it allows you to do, it allows you to get out of a property that you no longer want for whatever reason. You just don't want it. You are going to relocate. What you want to change into a different real estate asset. It allows you to move into that other asset. Use defer your gain and your capital gain and the taxes due by moving all your cash and equity into the next property, as well as the money you would normally pay to the IRS in taxes towards your next purchase.
So
you
it's
need
tax
to stay.
deferral. You're not
Yes.
paying any taxes on that gain on that investment property, but you're moving all proceeds from that transaction all into the next like kind. What is like kind property?
Like
mean?
kind in the realm of real estate is the asset class. So it's any type of investment real estate for any type of investment real estate. So you could go from a multifamily property to several vacation home rentals if you wanted to, or you could go into an apartment building or a strip
When
mall.
you say vacation rentals, could they be single family homes?
Yes.
As long as you're renting those out.
As long as you're using it for productive use in trade or business or for investment.
So you can't really use it as your own second home. It would have to be rented out.
No. And there's a distinct difference between what a vacation home is and what a rental, a second home is.
Yeah.
The IRS will allow you one other property to take a home mortgage interest deduction. So many people do that for their second homes, but they interchange the words. Vacation home is very different than a second home for tax purposes.
Gotcha.
Vacation home has guidance. In 2008, it's Revenue Procedure 2008-16, they issue guidance 24 months before you sell a property that you've either held as what you think a vacation rental. It may not be. It needs to look like this. For 24 months prior to sale, it needs to have been, you divide that into two 12-month periods.
Okay.
So each of the 12-month periods, you get 14 days of personal use time, or less than 10% of the time it's rented. So if it's been rented for 250 days, you could have 25.
Gotcha. So
Speak to your
it's
CPA
all about
yes.
It's all about the time spent in the property.
Yes, and there's other
important.
stuff too.
Yeah.
They have a list, but 24 months it needs to look like that. Now, if you want to buy it as replacement property,
Right.
there's a 24-month hold, and you're going to notice when you read the tax code, 24 months doesn't mean 2 years; they mean 24 months. So if you buy it as replacement property, it's 24 months after acquisition.
All right. So getting back to investment property with equity, right? So I've done this with a long time ago when I used to sell real estate. A long time ago.
Back when I met you.
Yeah, I did this with a real good friend of mine, and he started with a 3-family home, and the equity was increasing. And about 2 years, I think the equity was there. He actually traded that 3-family in for a 6-family. Then 2 years after that, he's trading that 6-family into a 12, and then the 12. When he was done, he had about a 36-unit property. And every single time, all you're really doing is, you're increasing your cash flow tremendously.
Yes.
Right? So, I mean, this is a cash flow play that once you start trading, why would you trade, say you have a 3-family, you wouldn't trade for less income. You're going to trade for more income.
Yes, that's the purpose of the code, is to keep people invested in real estate. And a lot more things. Again, we're talking about real estate today, but if you look at the broad scope, 1031 touches every section of our economy.
Yeah, and we're hoping there's not going to be any changes on this code. I mean, we'll soon find out if there'll be any changes, but we don't think that
We don't know.
We don't know yet.
We don't know.
But it's a great vehicle, and it creates wealth. There's no doubt. But can you talk a little bit about deferral though? I mean, you're not paying taxes on the gain, but in the future, do you pay the taxes on the gain? Like, when do you pay these taxes? Because I'm sure they're just not saying, oh, you have to pay taxes anymore.
Well, you know what? Here's the thing. If you want to keep part of your investment portfolio in real estate, this is great for tax planning. Unfortunately, too many people aren't sitting down with a knowledgeable CPA that understands real estate, who's the one that can give advice. We're going to talk about my role as a qualified intermediary in a minute, so you know why you need to have one. But they're your people that you will go to for advice. Now, many people have tax preparers, or they're doing their own taxes themselves. Once you are contemplating your first exchange, you really need to sit down with a knowledgeable tax professional to talk about how to use 1031 exchange and plan for your future. You may want to bring an estate planning attorney in on that too, because you can continue to defer taxes throughout the course of your life. You can use this over and over and over again, for your real estate investment needs and your income producing needs. Now, here's the deal. At some point in time, if you decide to sell, you pay taxes all the way back to, if you sell everything, let's just put it this way. If you sell everything, you pay taxes back from the beginning. But you could even sell a few things and just pay some tax along the way. But again, at the end of the day, it's part of your estate planning strategy.
Right. Okay.
So,
gotcha.
so I can't say, yes, you're going to pay taxes if you sell out or you sell some.
Right.
From exchangeable property, but if you're planning properly, you may not have to.
So you kick the can to the end, but if you have a good plan in place, are you really paying the taxes based on your estate plan or the plan that you put in place?
No, there could be some estate tax due upon death to your heirs. And again, you've got all those levels of things that you have to meet. You may or may not. Again, that's why it's important if you're going to use it as a tax planning strategy to sit down and lay it out.
But you're deferring your taxes. You're not paying taxes unless you sell that property.
Yes. You know what? Like anything else, you pay taxes upon sale.
Right.
No sale,
but when
no
you're
tax.
selling your property with the 1031, you're not paying any taxes up until the end.
Yes.
If you ever decide on selling.
Yeah, and that's on a full deferral.
Right. Okay. So let's talk about what is a qualified intermediary. So you're a QI, right? So
Yes.
Is that what they call it?
Yes. The abbreviated term is QI, qualified intermediary, exchange accommodator, exchange facilitator, all apply to this. The IRS says that in order to do a 1031 exchange, you need to engage the services of a qualified intermediary. The role is they're a non-related third party who sets up the appropriate 1031 exchange documents to make your transaction, your sale transaction, into a tax transaction too. So it's both. We actually take the proceeds of closing, because remember, the money that you would normally pay the government's in there.
Yeah.
Okay.
Yeah.
So we hold on to the funds. There's paperwork involved where we, by way of some of the paperwork we have, you're going to have direct deeding from your seller to your buyer. The QI no longer takes title like they did many, many years ago. So that eliminates double transfer tax. And then we work with your real estate agent. We work with your attorney or the closing company and your CPA to make sure that everything goes smoothly along the way. And then we wire the funds out with appropriate documentation when you buy your replacement
So
property.
you're holding the funds as well, almost like an escrow agent. You hold the funds and you know where it's going to go. Like, so for example, if you're out there and you want to sell your investment property, but you haven't found a property yet, what is the time frame that you have to locate that property?
Okay, well, this is all predicated on the closing date of your sale on your relinquished property. However, because it's a real estate transaction too, that doesn't mean you can't be out negotiating for the purchase of what you want to buy prior to getting yours sold. Just like, let me take a step back. Now we're talking about investment property, but I want to create an analogy. Brian, when you sell your house, or I'm sure you sold a house in the past, right? For yourself, your primary residence. So haven't you wanted to kind of know what it was you're going to buy so you don't have to put your furniture in storage or go live at the in-laws or rent an apartment?
Actually, I don't think I ever sold my personal house.
But when you were in real estate, did you have people that were you want to coordinate the sale of the purchase of your replacement property after your sale date. So you want to make sure the real estate agent you're working with is negotiating
Say I have a three-family and I got an offer and I said, okay, great offer. I'm gonna make a sizable gain. But wait a minute, I don't want to pay taxes. Is that kind of when it starts? When you can put your house on the market, see what it brings in, and then can you make it subject to you finding a 1031 exchange property?
You don't even need to write that in there.
You
just need to say, I'll be glad to set a closing date with you. Whatever your agent's real estate skills are for getting your purchase of your new property to close after the sale of your first one. The whole point of this is you don't have to wait till the date of the closing of your sale or until you get an accepted offer for what you're selling to start looking. You can start looking before. Now, market conditions are going to indicate how successful you'll be at getting a seller of a property. Kind of wait till you can set a closing date. But people do it all the time with houses.
But based on that closing date, if I was to close on that three-family that I'm selling, how long do I have to actually go find another property of like kind?
Okay, from the date you close the sale of your relinquished property, the timeline starts the date of closing or when the benefits and burdens of ownership transfer. That's a whole nother segment.
Okay.
We're not even going to go there.
All right.
So basically it's the closing date. You've got 180 calendar days, that includes weekends and holidays, to acquire your replacement property. The first
That's
45
6 months?
180 days. That's what the tax code says. That's what they mean. The first 45 days of that, 6 weeks. The first 45 days of that including weekends and holidays, is your identification period. By midnight of the 45th calendar day, you would notify in writing on the ID notice that the qualified intermediary supplies for you the correct property address, and if there's a unit number involved, unit number, city and state of the property that you want to identify.
Okay, so you have 180 days to identify the property.
No, to acquire
To
it.
acquire it.
The first
How long do you have to identify the property?
The first 45 days of that 180-day exchange period.
So within 45 days, month and a half, but tax code's 45 days, you have to identify the property you're buying.
Yes.
And after that point, you only have until
The
180
remainder.
days.
The remainder.
From 180 minus 45, you have that until close on it.
Yes.
So you've done one recently for somebody, and they waited to the very last day to close.
Yes, they did.
Very last day. So, I mean, it
Yes.
does happen.
So guess what that brings up? There's no extensions.
There's no extension.
Yeah, they don't, like, the rules are specific. There's a lot of gray area in this tax code, which can be frustrating when you're learning about it, but it's really good because life happens, right? So there's some gray area, which is great, but the timelines are set in stone. The only time there's an extension would be for like a federal disaster where the IRS will issue a revenue procedure. Revenue procedure is like the rule.
Yeah.
Where they will allow some extensions, for example, during Hurricane Harvey, during Hurricane Irma, and during the recent wildfires in California.
So if that seller didn't get all of their information intact to close on that day,
it's a
you're
failed
basically
exchange.
out of luck, and you have to pay all that tax that you weren't planning on paying.
Yes, you pay it you pay it on that year's tax return because your exchange is reported the year of the sale.
Okay, so if in fact you do take that offer, you are going to close on the property that you're selling. What if you can't find what if you just don't find a property? I mean, is there any other thing you can do?
Well, there's a couple things you can do. Let me address this first. If you can't find a property that's like nearby, in the area that you're looking for to actually where you're going to be on the title, it's yours, you're going to be collecting the income. There are properties out there called Delaware Statutory Trusts that are large, grade A institutional properties where you are a beneficial owner of the trust and a taxable owner of the trust. So you own it maybe with anywhere from a few to several hundred people, and you collect a check every month.
In common, like a tenant.
That was popular back in the early mid-2000s,
Yep.
but after the financial collapse, because those were based on an individual taxpayer's credit.
Yes.
This is based on the sponsor's credit and a DST. So, and it's non-recourse debt. It's a little bit more sophisticated. You have to be an accredited investor, which there's a series of things that you need to qualify for. But those properties may be available to people that
so
can't
like, for
find
example,
something.
if there's a skyscraper in Boston or a skyscraper in New York, there's portions of people that put money into this and they buy these properties.
And they just collect a check every month that comes in place with property management.
Right.
That could be something if you just can't find something and you're dead set, you don't want to pay those taxes, and you're an accredited investor. Now, for those people that are just out there and they're like, they still want to own their own, physically own their own properties, that they can, paint, repair, hire their son to go fix it, what have you.
Yeah.
Those types of properties, if you can't find something and that's what you want, then don't identify. You call the QI day 46 with some paperwork involved, and they will refund your money. When you sign your exchange agreement, you're actually signing away the rights to your money for the exchange period. Okay, it's called the G6. There's G6 restrictions in place.
Okay.
The QI can only release them when you've satisfied the terms of the contract, and that would be if you can't find anything to buy. Don't identify. Day 46, they give your money back. If you've identified, but for some reason you cannot get those property closed, the next time we can pay it out is day 181. If there's money, if you identify, say, a property or properties, and you've purchased them all, and there's still money in your account, once those properties are purchased, you can have them back. But if you identify several, you buy one, there's money left over, the next payout time for the remainder of the funds is still day 181, and that's due to the G6 restrictions, because conceivably you could still go buy one of those properties.
Right.
Okay.
Very interesting.
So
Lynne, if you can give us like a story of a recent deal that you did that would resonate with some of our listeners. People want to make money, right? The name of the show is Easy Money New England. We always like to say, right, Mr. Jonathan, there's no such thing as easy money.
There is no such thing as easy money.
And Jonathan, I mean, I know, you want to be a minimalist. But do you have any specific questions for Lynn? Because you usually jump in.
I'm curious about the difference between 24 months and 2 years and 180 days versus 6 months. Why is it so specific and it's not just the months?
Because basically that's what the Treasury regs that's what the IRS says. That's what they say. So let me just give you an example. So there is one of the biggest questions that I get constantly is, how long do I need to hold on to this property before I sell it again, move into it, change my tax reporting structure? I mean, it's multiple choice, pick any one of those. So when you're looking at, I've got a great article on our website called How Long to Hold. It's really subjective. So it's
called How Long to Hold, and how do I get that?
How long to hold? Just email me or go to www.apiexchange. That's the whole word,
APIexchange.com.
Yeah, and you'll find one, How Long to Hold. And basically, there are no holding requirements in the tax code. This is all about intent. What is your intent at the time of the sale of your property? How did you hold that property? Did you hold it for productive use in trade or business or for investment purposes? And what's your intent going forward? Okay, so that's your intent. There are going to be fact patterns and circumstances that are going to support that intent or not. So that being said, there's no holding requirement. However, we know that you can take a long-term capital gain in 1 year's time.
Yes.
Okay. We also know that in the tax code, there are 2 times that they do issue a holding requirement. Brian, say that you were my brother.
Yep.
And you have a property at Lakewood and Pisaki, and I have a place on Hampton Beach.
Yep.
Okay. And we decide we want to swap properties. You don't need a QI for that. As long as all the equities are all in place and it's an equal value property, we can swap. There's more stories about what happens if one's more. We're not going there today. That's part of if I'm talking to you for 7 hours.
Right.
Okay. You own a property. I own a property. They're equal value. They've been investment properties. We want to trade them. We can actually swap them. You don't need a QI, but you have to hold on to my property for 2 years, and I have to hold on to yours for 2 years, and it says 2 years.
Okay.
Okay. Now, in vacation home guidance, like I already told you, they issue a 24-month hold. They mean 24 months.
Right.
So you've got the difference between 2 years, which could really be every time we go to January, like right now it's 2017.
Yeah.
Guess what? January 2018 is a new taxable year.
Right.
So sometimes they'll look at 2 taxable years, but it's only a 12-month period, like June of 2017 to June 2018.
Right.
Is a 12-month period, 6 months in each year, but it's 2 tax years.
2 tax years. But it's 24 months still waiting period on that.
No. On vacation home guidance, they mean 24 months. So it gets a little technical. So
Right.
related parties swap 2-year hold.
Yeah.
Okay. Now, again, vacation home guidance, 24-month hold following their rules for vacation home guidance. So let's just put it this way. Less time is more risky. More time is less risky. So before you want to move into a property, before you want to change your tax reporting, before you want to do a 1031 exchange again, you'll want to talk to your CPA about the guidelines to see, okay, there's no holding requirements. This is my fact pattern. This is how long my attention. This is how long I've held it. Looking at the tax code, is it advisable for me to go ahead and sell, move in, change my tax reporting?
Right.
Okay.
So in New England, we have a bunch of waterfront property, right? This beach property, and I know we had that just the example of being brothers, but if I mean brother and sister, but if in fact someone had a beach house and they were thinking, I really want to, downsize or something, could they exchange that because someone's going to be buying that as more of a vacation property, or is it because what they used it as?
It doesn't make a difference what the person before you used it for or what the seller has used it for when you're buying it for replacement. It's all about what you are going to do with it, what the taxpayer, the exchanger, is going to do
On the
with that
buyer
property.
side of it.
Either side.
Right, but on the selling side of it, she's lived there all her life, say, and she's lived on a beach, like a beach house.
Well, that's not an investment property then. That's
So
your
you can't
primary
do it with
resident.
that.
Well, for you, in order for you to be able to exchange with your relative, it has to be an investment property if you're on the receiving end.
Okay.
So yeah, there's a lot of issues when
Right.
buying and selling with related parties. If you're selling to a related party, it doesn't make a difference what they use it for, but it does, but you're going to go buy a property from somebody else. But when you're buying from a related party, say you're buying, you want to buy a property from me and I'm your sister.
Yeah.
the property you buy from me as replacement property in an exchange, I have to be able to do a 1031 exchange also, which means you can only buy my investment property. You cannot buy my primary residence on the beach.
Right.
I don't care what you're going to use with that. I have to be able to do an exchange.
Right.
So if it's not been an investment property for me, you can't buy my property.
Right. So that gets a little technical.
Yeah, it does.
I think that, if you're interested in, say you have increased equity out there and you're thinking of selling, maybe the property's tough to manage. Maybe you want to be in a different area. Maybe you're in, the northern part of the state. You want to be closer to the city. Whatever it is, why you would want to exchange or sell that property, there's a tremendous amount of cash flow on the other side if you wanted to defer those taxes.
Yeah, many times people get relocated. I do a lot of business with people who have lived in the Boston area and have been transferred for work in the tech industry to California. And so they'll rent their property in Boston out for a while because obviously they're probably not sure if maybe they went out on contract and they weren't sure if they were going to be staying. So people want to eventually reallocate their assets.
I mean, I actually had a customer before. They actually did a 1031 exchange into triple net leases.
Yes.
Do you also do that as well?
I don't supply properties.
Oh,
definitely. Definitely. Yeah, there's companies out there. There's registered reps out there that sell the triple net lease properties.
So say you have a big portfolio of property and you're thinking, this is, maybe you're of age, you're thinking of retiring, but you don't want to pay the tax. If in fact you did an exchange into a triple net lease, I mean, you basically collected a payment.
A triple net lease property,
such as like a Walgreens
yes.
or a CVS,
yes.
or I know some Wendy's, or that type of property where they take care of all the upkeep, they take care of everything, and all you really do is collect.
As long as you're going to hold it for productive use in trade or business or for investment, one of the things you need to remember that the tax ID number under which you've been reporting needs to stay constant. So you cannot buy into an entity. So be careful when you're getting, and I'm not saying that happens with triple net properties. I just thought of it. Just be sure that you are going to own your portion of the property as the taxable owner of it, because the tax reporting needs to stay constant.
Right, and you don't get in the planning. That's where they get their own attorney, their own accountant, and you're more like the
yes.
You hold the money to make sure that
one of our roles besides setting up the documents, taking in the funds, and being part of the consulting with your professionals and you as the taxpayer. One of our roles is to help you structure questions to go ask these people. Many times a real estate agent will have someone call me directly, or a mortgage broker like yourself. You'll say, Lynne, listen, I just went to speak to this person. He's going to sell a property and he wants to buy a multifamily. It looks like it was an investment property to me. Would you talk to him?
Right.
So I get him on the phone. I find out about his tax reporting history. I find out about what he wants to do. And I'll say, okay, these are the questions I want you to go ask your CPA.
Right.
I want you to go ask him these questions to see if he feels that you would qualify and benefit from a 1031 exchange based on your tax reporting history. And if it makes sense for you going forward to do just that.
Right. So a lot of real estate agents, I mean, if a lot of them have, I just had, I was out to lunch with a real estate agent the other day, and I want to learn more about 1031 exchanges because, think about this as a real estate agent. You're actually selling their property, being the buyer's agent on the new property, and many times you may have a listing on that new property. There's ways to increase your personal cash flow as a realtor by showing people how to make money and more money and building their cash flow, their net worth.
Yes, absolutely. Well, here's the thing. If you're a real estate agent, broker out there, it's really smart to know that for every sale, there's a tax consequence.
Right.
And if you can guide people to know Section 121, that's the primary residence exclusion. Okay, know that. Again, on our website, we have information on primary residence rules. We also have information on split treatment transaction where it's part residential, part investment, like a bed and breakfast, for example, or an owner-occupied multi. Or if it's investment property, the tax deferral that Section 1031 provides, because you've only got two real straight-out tax codes specifically for the sale of real estate. Section 121 primary residence rules, Section 1031 investment property, which real estate is one of the asset classes, which is a tax deferral. So as an agent or a broker, it's not your job to give financial advice. It's not your fiduciary responsibility. So don't get your feet too dirty, but just bring up the fact that, you know what, you've held this out for investment, you may qualify for a 1031 exchange if you're going to stay invested in real
The
estate.
golden rule is if you
Yeah.
can, make people more money, you become successful like they are. But it's all about service,
Absolutely.
right? So
Absolutely.
I have a question though. I mean, say for example, I have a 6-family, and it might be in the northern part of the state, and I want to trade it. I'm going to sell it, and then I want to buy a property with an exchange, but it's a 3-unit building, maybe closer to town where it's more expensive. Can you do that even though you're going from a 6 to a 3?
The amount of units don't make a difference.
Doesn't
This is
matter.
all about the value.
It's all about the
Let
value.
me throw it out at you,
Okay.
Brian. You're selling something. It's all about the money.
Yes.
This show is called
It's
Easy Money.
New England.
How much
No such
easier
thing as
money
easy
can you get than money that you would normally pay in taxes to get to use it to maintain your wealth in real estate through other than Section 1031?
No, I
the
mean,
government's given you
right.
a way to get out of real estate that you no longer want, used, you're relocating. For example, here are reasons that people decide to
They want to sell.
They want to sell, but the exchange allows them to maintain their wealth in real estate by buying equal or greater in value than they sold.
In value, not
in value,
units. Okay,
not
'cause that's
units.
a very
It's all
that's
about
a
the
myth.
value. You have a sale, you're going to get taxed on it. So if you're selling a
right.
property for $500,000, okay, and you have you would have to pay capital gains. Say you bought it for $250,000, and between a talk with a qualified intermediary and your CPA,
Yeah.
your CPA says, you want to stay invested in real estate, so this would be a good move for you. Gives you an opportunity to increase that tax flow, cash flow, because maybe the building that you've been renting out, maybe you're at the top. The rent market won't take any higher rents in the area you're
Right.
in anymore.
Right.
So you either go to a building that's multiple units, you move into an area, you find a property where the rent values aren't having
Or
to
maybe
pull up
it's
that
near
much.
a college. Maybe they're getting bigger money, bigger rents.
Absolutely.
But that's a big misconception. I always thought that if you had a 2-family, you can't go buy a single family for investment purposes. But it doesn't matter. It's based on value, and it's based on investment property. As long as it's investment, you're okay.
Yes, and the appropriate use of the building under that term investment.
Right.
So-
Right.
For the real estate.
That sounded
yes.
really compliant there. That was pretty good.
Well, you know what? It's just a matter of people hear things in different ways, and I try to say the same thing in a different fashion all the time so that we're on the same page.
So say they don't have the down payment, all right? So say they sold the 3-family and they want to go ahead and put an offer on their replacement. How do they do that if they don't have the down payment to put down?
Because they haven't sold theirs yet.
Yeah.
Okay, so let's just go a real life scenario. This happens all the time.
Okay.
Because in our marketplace the inventory is tight.
Yeah.
People are going out before theirs is sold because they want to get that replacement property locked up in an accepted offer P&S contract before they get theirs sold. Get the money from under your mattress, the coffee cans in the backyard, your money market account, Aunt Linda, Visa, wherever you can cobble together your down payment money to put down with your offer or that initial down payment that they want. That's your funds. When you go ahead and do that, you can enter into your contract.
Okay.
Just make sure the closing date, like I said, is going to be set for after the sale of your relinquished property. But you can get that money back when you go to purchase that property as a reimbursement for a cash out-of-pocket expense for your earnest money deposit, because that money you borrowed from Aunt Linda to go make that down payment, that's not your sale/exchange proceeds. That's your money.
Okay.
So you're entitled to have that back.
All right. So another example here. So say for example, you're going to clear quite a bit of money on this. You're going to sell your 3-family. You're basically going to buy another one. Maybe it's a different location. You got relocated, whatever it is, and you're going into that deal with no mortgage. Could you ever take a refinance and take the money off the table that you want? Because
I'm glad you're going down that road. Okay, because guess what? What you don't want to do.
Okay.
Is refinance your property prior to the sale and keep all the cash and then do a 1031 exchange. Because in an audit, if it's disclosed or and again, when the IRS, if you're reporting under your social security number on your 1040, the audits are random.
Okay.
So the fact that you're doing a 1031 exchange is not going to trigger your audit. It's just if you're whatever system they use, it will come up, they see the exchange, they're going to investigate it. If it's discovered that you have refinanced your property right before an exchange and you went and bought a boat, took a trip to Europe, paid your kids college,
Yep.
that could invalidate your exchange.
But I'm sure these
if you-
IRS laws are pretty vague, or are they pretty succinct?
I've got information on that too.
Yeah,
So,
but is there a timeline?
Well,
Say you
here's-
refinanced 5 years ago.
that's fine.
Okay,
That's fine. But if it's right before your exchange, if it's for the significant benefit of repairing that property or taking the benefit of a lower interest rate prior to a sale, and again, you'll consult your CPA.
Yeah.
Then that would probably be okay because it's for the benefit of that property.
Right.
All right. So there's some guidance there.
Yeah.
All right. However, so we're not going to refinance it just to go buy a boat before you sell it.
Course,
So you're
yeah.
set up for sale. You want to buy your replacement property. All your sale and cash sale proceeds go into the next property after you have satisfied your exchange. Okay, after you buy your replacement property, and if you want to tap into some of that money, say if this was an all cash deal,
Yeah, so you have no
then
mortgage
you
on the
come
one
to
you're
you,
buying.
Brian.
Right.
You come to you, Brian, and say, okay, I'd like to take a home equity line. I'd like to refinance this property. Yes, after the fact.
You can do that.
Yeah, get up the next day, satisfy your exchange, and then go have that conversation.
Wow, that's interesting.
Okay.
So
The issues come is if there's a mortgage on the property and you're getting a new mortgage on the property because of Dodd-Frank and the trade regs,
yes,
and now the mortgage companies may not lend for 6 months or 12 months on that property.
on the cash out, right?
Right. And you do have
Yeah,
to
there
wait.
are some
So-
programs now that will allow you to do, no waiting period, which I just learned about recently. But
Let me know what those
yeah,
are.
very
I can send
interesting.
people your way.
Yeah, definitely. So very interesting that you can still refinance. It's not like you can't, hands off. It's just you're selling your building, you're deferring it over, you got a new property, and it's yours. You do whatever you want with it at that time. If you want to refinance, you
But
can do that.
don't move in.
Yeah, just don't move in.
At the time of the exchange, the purpose of this transaction is to sell property that you've held for productive use in trade or business or for investment and buy property solely for the same purposes.
It's a great.
Okay.
I mean, it's maybe I'm a nerd, but I love this. I love this 1031 exchange product.
I've been a nerd for 17 years.
I mean, it is complicated though. So I mean, if anyone's listening out there and you do want to get more guidance, I mean, you can email us over at info@newfed.com or Lynn, what's your email address?
My email address is Lynne, Lynne, at A for asset, P for preservation, I for incorporated, the whole word exchange.com. So it's Lynne at apiexchange.com.
Yeah, I think it's I've seen people create wealth with this product, and it's always been very interesting. And we have someone in the studio audience right now who might be looking at an exchange. I know he has a lot of property in and around this area. But Jonathan, before we kind of wrap it up, I mean, what do you think? Do you have any questions? I know you want to be a minimalist, and
I am a minimalist, but you said something earlier, Lynn, about equal exchange when you did the brother-sister analogy. How equal is equal in that exchange?
That would be determined by the values, and I would normally have someone, because I don't get involved in that if I was swapping with my brother, Brian.
Yes.
I don't get involved in that as a QI.
Okay.
But if somebody called me about that which they have recently, I would send them to their CPA to figure those out, make sure that would work for them.
Gotcha.
But again, it's all about, just to sum this kind of this addition up is it's all about cash flow, right? So it's all about cash flow. If I'm making $1,500 a month on my property today, but it's worth a lot more, your options are you can refinance it, take some money out, maybe buy another property, or you could sell that property, exchange it into a like kind investment for investment, and increase your cash flow if it's a better opportunity. I mean, you're going to be able to break these down, look at cap rates, kind of see what the income will be. But you can do this multiple times. Is there any limit on how many times you can do an exchange?
Well, you know what? Not really. You can exchange throughout the course of your lifetime. However, when you get people that may want to sell multiple properties at one time, I usually, if you're going to do it repeatedly throughout the year, one needs to go meet with their CPA anyway to make sure you're not considered a dealer.
Yep.
The IRS is a little bit more, they scrutinize a little bit more on people that are in the real estate business or building business.
Yep.
When they're doing a lot and selling a lot of properties in 1 year. But that doesn't mean you can't. I mean, I actually have had a gentleman who's owned 33 rental homes for a very long time, and he sold them all and bought 47 more. So again, you're going to be a guy like that has somebody that's competent to work with.
Well, yeah, you would hope so.
Yeah. So there's a lot of questions I'm going to ask and say, okay, I want you to go ask this question. So you can exchange throughout the course of your life, like I said. you can, and just meet with your tax professional to be sure that this is in your best interest, to be sure
Get
you've
your
met
team
the
together.
requirements.
I mean, it's all about having,
Have-
our last show was about a dream team, and get your team together where, when the opportunity strikes, you have your team ready.
Yeah, and what I like to see people do, and real estate agents, and brokers, and loan originators, loan officers are excellent at calling a QI and saying, Lynn, I have this client who I can get them great information. Again, we have at least 150 topics available about 1031 exchange and different parts of it that I can provide printed materials for that client to go take, that taxpayer to go take to their CPA and say, okay, I want to have a conversation on this topic because I'm thinking about doing a 1031 exchange, taking a look at my tax reporting history and my intentions. What do you think? Mr. and Ms. CBA, what do you think? Is this a good option for me?
And we hope there'll be no changes to the tax code, and we'll be finding that out pretty soon. Hopefully, there's no changes to this tax code. Because,
Absolutely.
if there is, we'll have you back on the show. We'll talk about it.
Sure. Well, as part of tax reform, if I can just take a minute or two, a couple of things that I would like to wrap up with.
Yeah.
First of all, 1031 exchange is a tax election for investment property or partial investment property. It's a tax deferral on like-kind assets. Real estate is one of those assets you have to exchange within the asset class. If you are selling an investment property, you must use the services of a qualified intermediary in order for it to be a legitimate exchange, or at least start out legitimately. And that doesn't mean illegally. That means just appropriately. Right. I should have used a better word.
Yep.
Secondly, it's all about your intent. The intent at the time of the exchange must be to sell property that's been used for productive use in trade or business or for investment. You're going to buy the property that you're going to use the same way. Please know the qualified intermediary industry is non-regulated. There are no regulations on the industry. So really check out the company you're working with.
So it's important to find a good QI.
Yes. For example, you want to ask questions like, is it just you? I can happy to say it is not just me. I'm part of a national firm. If something, God forbid, happened to me, there are 30 people behind me that where we've got our information entered into a system.
So it's sort of like Bernie Madoff Inc.
Yeah,
What I mean?
Absolutely. It's entered into a system. You can't reach me. You've got numbers to the company, to the operations center. Your exchange is going to get completed. Be
Very
careful
important.
of someone that says, I've got a person down the hall that can do that. Be sure they have backup
this
systems.
person's
if
holding
they're
your
unavailable.
money, right?
They're holding your money.
Yeah.
Where is it banked?
Right.
Who are the banks? How many exchanges have they done? Have they been in business a long time? How safe are your funds? Do you have E&O insurance? Do you have a fidelity bond?
Have you ever heard a
coverage?
story of someone taking that money as a qualified?
Yes.
You have?
Mhm.
Wow.
Yeah, well, Bernie Madoff is one.
Oh, he's
Not
done.
Bernie Madoff. I'm sorry. What's the Ed Open?
Oh, okay.
If you've ever seen American Greed, there was a whole.
Oh, it's American
whole
Greed?
it was a whole show about
I
that.
don't know
Yeah.
how they do that, but that's
So
that's bad.
Want to check out? You want to just check out the people you're working with.
Yeah,
But you do need
it's
to have a
important.
qualified intermediary. You do need to go by the timelines to have a successful exchange. Again, visit our website www.apiexchange.com. You can do a little research on your own, or give me a call. May I give my phone number?
Sure.
It's 800-883-1031. 800-883-1031.
Great. And if you're a real estate agent out there and you want to learn more as well, we set up teams with loan originators as well as realtors and really help people increase their wealth. I mean, that's really the name of the game. If you could teach people how to create more opportunity for themselves, then again, it creates more opportunity for you.
Glad to have that discussion with them. And also remember, 1031 exchange documents need to be in place at the time of the closing of the sale. I'm very sad when I get phone calls to say, I just closed my sale last week. Can I
Do you ever get a
1031
call that says I'm
exchange?"
closing at 1 o'clock on Friday and
Yes.
today is Friday morning at 10? I need to do
Yes.
something?
Yes. Call me. I can save the deal. I can save the deal that day.
Really?
Save it at the closing table, provided
You just got to know before it closes.
before it closes. It's not an ideal situation,
Right.
because you're going to be scrambling to buy replacement property, but at least you have an option to find something, because once it's closed, it's closed. You cannot go back and set it up.
And so if that person's supposed to close that day at 1 o'clock and they call you at 10 and you work your magic, you come in as a superhero. If they don't find anything within that 6-month time frame, no,
Within-
45 days, if they don't find anything within that 45-day time frame,
Call us on day 46. You fill out all the forms,
You
and
get
we'll
your
wire
money
your money
back.
back. Yeah.
So you're paying taxes, but
we
at least
retain
you
our
still
fee.
get your money.
Yes, you get your money back. There's no penalties,
No,
nothing like that.
no
They don't
penalties.
take your firstborn, nothing. So, so yeah, we retain the QI retains their fee, but you get your.
So You talk about QI fee. What's the range on a QI fee? Depending on, is it based on how complicated it is, or is it based?
No, most QIs nowadays have a fee for service, and it's within a range.
Yep.
No reason to pay ridiculous amounts of money, but
But it's not like $20,000.
no. Our fees range between $1,000 and $2,000. It covers the sale of the relinquished property and the purchase of replacement
So
property.
that's money well spent.
Oh, absolutely, absolutely. It's kind of like set it up. It's kind of like an insurance policy.
Yep.
I mean, because you at least provide you an option of time to go find something suitable.
All right, I think we hit all the spots here, and I thought that was a great episode. And if you have any questions, reach out.
Thank you.
Lynne?
Great time. Thanks.
It's a new day, it's a new way. Call 877-NEW-FED-1. It's a new way.
Hi, folks. It's DAmico, owner of New Fed Mortgage, and I'm really excited to introduce Fast Track Mortgage, our new online system that gets you approved in less than 15 minutes. Whether it's a refinance or a new purchase, just go to newfed.com anytime, day or night, and click on the Fast Track Mortgage button. Fill out the form, and within 15 minutes, we'll approve your loan at the lowest rate possible. Don't waste time dealing with big banks. We're local and here to help you close your loan fast. Just go to newfed.com 24/7 and get approved in less than 15 minutes. Fast Track from New Fed Mortgage. Now that's a new way to get the loan you need fast.
877-NEW-FED-1.
Subject to credit approval, Equal Housing Lender, NMLS number 1881. Call us to the website for details.
877-NEW-FED-1.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21 Podcast Cafe, the United Podcast Network, its partners, or affiliates.